Good evening, everyone. On behalf of National Stock Exchange of India and CIEL, we extend a very warm welcome to each one of you for joining us today for this live session on ETFs, Smart Investment Strategy for Achieving Life Goals. To share insights on this concept, we have with us Mr. Nikunj Sharma, Director on the board of CIEL, with over 25 years of rich work experience across mutual funds, investment banking, broking, sales and distribution, and training. Nikunj founded Money Yogi Corporation in 2015 and authored The Stock Market Monk in the same year. He has a deep understanding of investments and valuation concepts along with functioning of businesses across BFSI industry. Nikunj is a versatile speaker and a dynamic trainer as well. Welcome, Nikunj, and over to you now.
Thank you, Kirti, for a short and sweet introduction. I welcome the participants on behalf of National Stock Exchange and the CIEL, the company which I represent. As Kirti told you, I have been in the industry for almost 25 years, and I've been associated with banking and financial services. When I started my career, India did not have these many investment options. There were very few shares which were listed on the stock exchanges. Mutual funds were just coming into being. And of course, we did not have ETFs at that point of time. Mutual fund industry used to be very small, and fixed deposits, IPOs, non-convertible debentures, these were the instruments that we used to deal with. Of course, from those days, we've come a long way, and I am very privileged to say that I've seen so many products come and go that it has helped me grow as an investor and grow, of course, as a training professional. One of the things I must tell you, when I was writing my book way back in 2012-13, some of the most important learnings of my life happened then. I wrote the book and then I got scared whether people will read my book or not. So I went to a lot of people, a lot of friends, and in fact, I took 15 photocopies of my book. I gave it to my friends and I told them, okay, boss, you please give me a feedback. Once you give me feedback, then only I'll get the book published. And most of my friends started praising that book, and they praised it so much. They praised it so much that I became doubtful. The doubt in my mind actually doubled. I said, no, there is something wrong, Nikunj. Everyone is praising you, and you're not such a great, talented person. Why is everyone praising you? So somebody suggested that I must give this book to a person who doesn't understand investing. So I gave the book to my daughter. She was in 9th grade. And I asked her to read the book, give me a feedback. She took the book and gave me a feedback within 5 minutes. She said, Papa, don't print this book. Don't publish it. I said, why? She said, this is a 3rd grade book. Nobody is going to read it. I said, why? She said, because you've written it in such a complicated fashion that people are not going to understand anything. And she had underlined few sentences. She said, I've read only 2 pages. I did not want to read the 3rd one and the 4th one. And one of the sentences was, the ripple effect of cross-currency fluctuations will be seen on Indian macros, which will have a telling impact on the corporate balance sheets, which will help their valuations improve. She said, in a country where basic mutual funds are not understood, fixed deposits are not understood, who will understand this ripple effect and domino effect? She said, if you want to teach somebody, you have to keep things simple. I said, but this is finance. This can't be simple. She said, no. If you cannot explain a thing in simple language and in such a simple manner that even a 5th grader can understand that, it means that you yourself have not understood it. And my eyes got opened. I said, okay, I'll make the book simple. Second thing she told me is write this book into form of a story. I said, why story? She said, because finance is a very boring subject. Nobody wants to read it. So when you write it in form of a story, maybe it will magnetize people. It will help your readers along the way. When they're reading story, it will help them understand the investment related concepts. And I made those changes. I wrote it in form of a story. And there are 3 messages which I feel are very important for anyone, whether he's a stock market investor, a fixed deposit investor, or for that matter, a exchange traded fund ETF investor. The first message is that investing is like life. There are no shortcuts. In your life, there are no shortcuts. In stock markets, there are no shortcuts. No matter how intelligent you are, there are no shortcuts. Second message is investing is very simple. Don't complicate it. A lot of people complicate it. I'll do option strategy. I'll do cryptos. I'll do long short. I'll do derivatives. I'll do very complicated investment strategies, esoteric strategies. Keep it simple. The core part of your portfolio should be very simple. And the third message of this book is that don't make money, create wealth. All of us are living in a great country at the right time where the economy is booming, population is young, and I believe it presents a great opportunity to all of us for creation of wealth and achieving our financial goals, which is incidentally our topic today. Okay, how ETFs can help us invest in a very smart way. And why should we invest smartly? Because we have to achieve our financial goals. So this is the flow of the presentation. First, we will try to understand, give me 1 minute. We will first understand a few basics of ETF. Let me caution you here, I will not go into greater details of ETF because I believe that most of us understand ETFs. In case there is a basic question, you may please ask. Second, how do you become a smart investor? What is the smart investing? We will share with you what we think is a smart investing strategy. And third thing we will discuss is some of the key aspects of ETFs, the advantages of going through exchange traded funds. And fourth is we will talk about a couple of goals and how ETFs can help us in achieving those goals. And of course, the final part, how should you select an ETF? What should you look at in a ETF? So putting it very simply, we all know how a stock is traded on a stock exchange. You go to a broker, you place an order for stock, the stock will come in your demat account. Some brokerage will be charged to you, some security transaction tax will be taken from you, and your transaction is done. You don't know who the buyer is, the seller doesn't know who the buyer is, the buyer doesn't know who the seller is, but your trade is settled. Exchange traded fund or ETF combines a stock and mutual fund. So basically, instead of trading a stock or buying a stock, you are buying a mutual fund scheme, which is ETF. And this mutual fund scheme is doing nothing, but it is representing an index. It could be Nifty 50, it could be some other index. So what is ETF doing? It is bringing best of both the worlds to you. You're getting real-time prices like a stock, and you are getting the mutual fund portfolio. So mutual fund portfolio brings your risk down. And features of a stock, they give you flexibility. Real-time price discovery is there. So when you buy a mutual fund, you are exiting and entering the mutual fund at the day end prices. But in ETF, Suppose you feel that the market by first half will go up and after that the market will go down. You can sell your ETF at any point of time. So it gives you trading flexibility and it brings your risk down because you are dealing with a portfolio. So if you are dealing with, let's say, Nifty 50, then you're dealing with 50 stocks. The fourth advantage is it is affordable. In a mutual fund, when you're investing, you have to invest minimum 5,000 rupees, 10,000 rupees. Here, one unit will cost you about 100 rupees. So you just like buying a 100 rupee share. And I'm talking of course, Nifty 50 index. And the delivery of the ETF will be done in your demat account. So for those who are new to ETFs, it is similar to a stock, but that stock is nothing but an index fund. So you can trade on your index fund at any point during the day. Another way of looking at an ETF is, and somebody told this to me a couple of days back, he says, Nikunj, you look at a cricket team. Let's take an example of 1983. Recently, a movie was also made on that. 1983 India World Cup team. Nobody gave us a chance. Nobody thought that India would win a World Cup. We had never won a single match in the World Cup. But who was our team composed of? Shrikant, a great batsman. Mohinder Amarnath, an all-rounder. Dilip Vengsarkar, a great batsman. Gavaskar, a great batsman. Shastri, a spinner and a batsman. He was an all-rounder. Kapil Dev, all-rounder. Yashpal Sharma, a great batsman and a great fielder. Roger Binney, a good all-rounder. So the advantage was, and if you go through those matches, in some matches, Gavaskar scored the runs. In some matches, Yashpal Sharma played. In some matches, Kapil Dev played. One of the matches we won because Roger Binney took 4 wickets. So it was an all-season team. An index fund or an ETF is like that. You have bought the entire index. Let's say there are 50 stocks. So some stocks will be from chemical sector, some stocks will be from FMCG sector, some stocks will be from banking sector. If banking doesn't do well, let's say markets are falling, banking doesn't do well, your FMCG will do well, consumer goods will do well. If markets are going up, your aggressive sectors like capital goods, banking sector, these things will do well. I remember, when I was small, I used to read these religious scriptures, and in one of our scriptures, Lord Hanuman, and I'm talking about Ramayana, when Meghnad hit Lakshman with an arrow in his heart, Lakshman became unconscious, and they said he will not survive unless and until you go and find a Sanjeevani Booty. Sanjeevani Booty was there on the, I think, Dronagiri Parvat. So Hanuman flies to that Parvat, and there he is not able to find anything. He says, I don't know what Sanjeevani Booty looks like. So what does he do? He picks up the entire Parvat, the entire mountain. And he says, let me take the entire mountain. The Vad will find a booty here and Lakshman would be treated. And that trick worked. So what did Hanuman do? He brought his risk down. Instead of picking up the wrong jadi booty, he picked up the entire mountain. And that's one of the investing tenets which I want all of us to understand very clearly. Removal of the risk. Investing is about reducing your risk, because when the risk is low, our mind is very light. Our fear is less. And when our fear is less, we can think very, very clearly. And I'll come to that aspect slightly later. So what do different investors need? Somebody, wants to achieve his retirement goal. Somebody wants to do a startup. Somebody says, yeah, how should I actually invest in market? How should I, let's say, establish myself as a smart investor? And there are a lot of people who say, which shares should I buy? I don't know which shares to pick up. This is the common issue with the investors. They don't know which shares to buy. People don't know about retirement. When I ask people, how much money do you need on retirement? They have no clue. They say, maybe, sir, 1 year, 1 crore, 2 crore. You ask a youngster, he'll tell you 2 crores, 3 crores. And when you tell him your retirement is 40 years away, you will not 2 crores, but probably 15 to 20 crores. They almost faint. They said, sir, how we will earn that much money? And believe me, it is very simple. If we are aware of the investment options which are available to us, and if we understand them well, 90% of our job is done. Why investors not able to achieve their financial goals? Why they are not able to create wealth? If I show you some of the reasons which I've gathered from my experience and my discussion with a lot of experts in the markets, believe me, you will be surprised. The first reason is investors think that investing cannot be simple. It is complex. Unless and until you know which stock to buy, which to sell, unless and until you know how to buy low, sell high, you will not make money in equities. Believe me, I've been investing my money in equity markets for the last 25 years. And I've never ever traded either in an ETF or a mutual fund or a stock. So investing, they believe, is complex, which makes them do mistakes because you are trying complicated things. When you don't understand simple things, you're trying the most complicated things. So people who don't understand what a stock is, you will often find them doing derivative strategies sitting at a broker's counter. Second, because of this, because they think that market is complex, they are not able to invest for long-term time period. They are not spending time in the market. And if you don't spend time in the market, what will happen? You will not create wealth because market is nothing. Market is made up of shares, and shares prices will go up when the companies earn profits. And we know that companies will earn much more profit in longer term than in shorter term. So one of the conditions of achieving your financial goals is spend long-term period in the market, but people are not able to do it because they are worried. Why they are worried? Because markets are volatile. Look at these days what happens. Morning the market is up 200 points. By evening it will be minus 700 points. During the day it will be 400 points. We saw the volatility in COVID period. In about 15 days time, markets fell by 30%. And recently Ukraine war, what happened? One day markets went down by 3,000 points, 2,700 points fall in one day, which is equivalent to 6% fall. People think volatility is risk. It is not risk, but they are afraid of volatility. And because of this volatility, what they do another thing which I think is very unnecessary in the markets. They take 0-1 calls. When they lose money in equity, they say, I will never invest in equity. They go out of equity. And some of these problems you can see very clearly are not related to technical capabilities. They are related to my behavior. To my mind, investing has to be done over a longer period. As I told you, there are no shortcuts. Second, good investing is always simple. A thing of beauty is a joy forever, William Wordsworth had said. Simple thing is always beautiful. A simple portfolio is always beautiful. Complex things you will not understand. Third learning is how you invest is more important than where you invest. Let me give you a good example. Stock market is same for everyone. But Warren Buffett makes billions of dollars. And there are so many investors who are not even able to make 10,000, 20,000 rupees in the stock market. Stock market is same, stocks are same. So why is one person selling his house? And why is one person creating billions of dollars in wealth? The difference is there is a difference in the way they are investing. One person is probably trading in the market, and second is a long-term investor. Warren Buffett has invested in markets for almost 75 years now. Another learning is that investment is not a competition. You're not competing with anyone. So if somebody comes to you and says, yeah, my fund has given you more returns than yours, don't worry, we are not competing. Let's say your child has scored 95% marks. So does it mean that, if somebody else's child scores 98% mark, your child becomes unskilled or nalayak? No, it doesn't. This thing will happen. Somebody's portfolio will do better than you. There are a lot of people who will do worse than you. It's okay. That's part of life. So in investing, even if you are average, you will do very well. You don't have to be the best. You don't have to be the first. And the final learning is good behavior will take you farther than good knowledge can. You may have all the knowledge in the world about stocks, mutual funds, everything. But if you do not know how to respond to different situations in the market, then you will end up doing mistakes. So what is needed? If you read great investors, Charlie Munger, Warren Buffett, Rakesh Jhunjhunwala, Ramesh Damani, or let's say Howard Marks, they tell you only one thing. They say you should have a framework which should create discipline. And second, which should take behavior out of equation. Means what? Your system that you are going to create, it should not lead to emotional outbursts. Then you will achieve all your financial goals. And let me draw a very interesting parallel here. I practice yoga. Yoga says that there are 5 reasons of sorrows in our life. These are called panchakleshas. Avidya, asmita, raga, dvesha, abhinivesha, panchaklesha. He says that people invite sorrow in their life because of 5 reasons. First is avidya. Avidya is nothing but ignorance, lack of knowledge. You don't know about something, yet you are saying, I will do it. Common example, equity. 99% of the investors don't understand which stock to buy, which stock not to buy, but they will go and trade at a broker's counter. They will bring sorrow to their life. After 3 months, they will say, oh, equities are bad.
You can.
Second, asmita, ego. Sometimes, let's say you are a new investor, you started investing, in a couple of months, you made good money. You will start believing that I know everything. Why? Because last 2 months, I started investing as an experiment and I'm making money. That's ego. So what will happen when markets take a U-turn? You will be holding on to your ego. Okay, I will show the market how money is made and you will lose everything. We've seen plenty of examples. Third is raga. People get attached. We got attached to Infotech shares in the year 2000. We got attached to infrastructure shares in 2008. At the time of Harshad Mehta scam, we got attached to capital goods shares, cement companies. And we will not sell. No, yaar, I bought this share at 2,500. Why should I sell it when it is 50? Attachment. So when you get attached, there is a problem. People who are attached to Infotech shares, what happened in the next cycle? Your old economy shares started running. And people who are invested in Infotech funds, they virtually did not make any money for next 5-6 years. So one has to be flexible. You cannot get attached to any sector. The next reason is dvesha, aversion. Once they lose a lot of money in one asset class, they will say, I will not invest here. And then there is abhinivesha, fear of loss. People do not invest in equity because they think markets are volatile and it can make them lose money. If you create a system which can remove all these panchakleshas, believe me, you will create wealth. And the good news is an ETF can do all of these things. It removes avidya because the index is already made by the stock exchange. You need not know any knowledge. The index is already chosen by them. All the good companies are there in the index. And you are buying those good companies. So that means you need not have any knowledge which company I should buy. That is taken care. Ego. Because you are not choosing any single stock, you will not be boasting about it. You will just say, I bought a portfolio, I bought an index. ETF is nothing but an index which can be traded. Ego will not come to you because you're not saying that I bought XYZ stock which became 10 times, 15 times. No. Raga, you will not get attached to any sector or any share because in your portfolio there are 50 shares. Which share will you get attached to? And because you're not getting attached to anything, your expectations will be low. And there will be no dvesha. That means you will never ever, because you will be investing in a way, and I'll tell you how to invest. You will be investing in a way where you will neither get attached to shares, nor you will start hating them. And abhinivesha, how do you remove abhinivesha? You have to accept that markets can go through ups and down and you have to adjust your behavior accordingly. So ETFs will take care of these 4 or 5 things, and discipline will take care of the abhinivesha. And that is the system that you have to create. There are a lot of long-term goals which need equity investing. For example, for a youngster who's 20-year-old, his retirement is 40 years away. He cannot achieve his retirement goal by investing into a bond. He has to invest in equity. So he has to earn market-linked return for 40 years. But the problem is people don't stay invested for 40 years. Anyone who can stay invested for 40 years has done a good job. Our index started in 1979 and today it's given you 14-15% return. Nifty started in 1990, July 1990. And the current return, if I take the return so far, the return will be close to again 14-15%. So create a system which helps you earn market-linked returns. That's first. And second, the system should be so good that it makes you stay invested for longer period. Why do you need to stay invested in longer periods? Because in longer periods, the profit of company increases multifold. So there is a company, one of the largest companies in India, its profit used to be 100 crore rupees in 80s. Today, the profit is 50,000 crores. One of the large banks, its profit used to be 30 crores at one point of time. Today, the profit is 40,000 crores. In 20-30 years, the profits have grown almost 300-400 times. And that is what creates the wealth. If you can do these two things, okay, earn market-related returns and stay invested for a longer period, you will be one of the smartest investors. And that brings me to a very interesting thing, which I call smart investing. What is smart investing? So what we did, we took these 5 words, SMART. And from these words, we will give you a strategy, which is based on what is good investing. And everything I will show you how a ETF is a smart investment. So first thing is S stands for simple and easy to understand. Now tell me what is easier to understand than an index fund. If you can understand an index fund, you can understand an ETF. The index is already made. The fund manager goes and trades in those stocks. He just buys the index basket. Simple to understand. There'll be 8 to 10 sectors, few leading companies in those sectors, they are the part of the index. And it is not only easy to understand, but it is also very easy to execute. You have to just press a button, place an order, and your broker will execute the order. So ETFs, to my mind, are the simplest products. Index funds and ETFs are the simplest products to understand. The only disadvantage with index fund is you cannot exit during the day. So ETF removes that. ETF you can trade at any point of time. 9 o'clock, 9:30 markets will open. Then till 4:30 or 3:30, you can trade at any point of time, just like a stock. So ETFs are simple and easy to understand. M stands for mindful and market oriented. Mindfulness is a great virtue. See what happens. How do we do mistakes? Why do people do mistakes? Your mind can be divided into two parts. One part is logic and one part is emotion. What is logic and what is emotion? Logic is reflection. You reflect on something. If I ask you, if I take you to a seashore and I show you 10 boats and I ask you, sir, tell me which boat is the fastest, you will observe it. You will observe all those 10 boats and then you will tell me, sir, that blue color boat is fastest and the red color boat is the slowest. If I give you a very complicated problem in mathematics, let's say, integration of cos square theta minus sin square theta plus cot theta square. If you were to do that, you can't do it immediately. You will sit with a notebook. If I give you a quadratic equation, if I give you a problem in physics, you need to reflect. But if I ask you a very simple question, sir, what is the time? You will just look at your watch and tell me the time. You're going in a local train, somebody pushes you, you immediately push him back. So the second part of my brain works on reflex. You're walking on a street, people are playing cricket, the ball comes to your side, you immediately catch the ball. When markets are volatile, when markets are continuously falling, the part which is based on reflexes starts dominating the part of reflection. And that fear will not let you think. And that's where people take decisions. Okay, let me not invest in equity, stop all my SIP, stop all my ETFs. So the reflexive brain starts dominating the reflective brain. If you are mindful, if you know how markets work, if you have knowledge of market cycles, if you know that, a market has so many sectors, not every sector is falling, mindfulness. So when you are investing in ETF, all sectors are covered. You are being mindful. You are buying some of the largest companies because largest companies only will come in that index. You are being mindful and you are being market oriented. How? Because that is what the market is. Today, if you take Nifty 50 and if you take Nifty Next, between these two indices, 90% of the market is covered. There is nothing left beyond that. Just invest in these two indices and you're done. So when you are investing in ETF, you are not only mindful, but you are also market oriented. And third thing is a smart investing. A stands for automatic. Your investing should be based on a process. What is ETF doing? ETF says these are the 30 or 50 companies I am going to buy. That means what? He has taken the human element out of the equation. Which stock to buy? A lot of errors can be done when you're picking up stocks. If you don't know how to pick stocks, what will you do? You will do mistakes. So ETF has already removed those mistakes out of the system by saying this is a good index. I will buy all these 50 companies. That's automatic. It has taken all the human decision making out of the equation. And second, how do you automate ETF? You can start a SIP in ETF. Some brokerages allow you doing margin trades, limit orders. You can, do those quant type of things with ETFs. So what is happening now? Automatically, you are getting the entire market breadth. You are getting diversification. You are getting the benefit of those 40, 50 leading companies. Nothing can be more beautiful than that. Let me give you a very simple example. If you did a SIP in Nifty 50, okay, you may be an engineer, you may be a chartered accountant, you may be a doctor, lawyer, or you may be a student, or you may be, let's say, not even qualified in terms of investing. You may be, somebody, let's say, who's not gone to school. But if you did only a simple thing, when Nifty was launched, you started a SIP, and at that time, of course, ETFs were not there. And you said, I will invest 5,000 rupees per month in Nifty 50. So your total investment till date would have been 19 lakh 5,000. But this money has become almost 2 crore rupees now. How many years? From 1990 to 2022. 30 years. What you did? Only bought an ETF every month. You are sitting on 2 crore rupees. That's a return of almost 13%. Believe me, many good equity investors are not able to produce a return of 13-14% for a 32-year period. And why this is 13 year? Because Nifty started in 1990. By that time, markets are already grown. Markets are already grown. Your, let's say, I remember, 1979, BSE index was 100. And by the time 1990 came, the index had already become 2000. So a 20-time growth has already come by that time. A 13% return by doing only a simple thing where you're not bothered about picking anything, you're not bothered about timing. You did a simple thing. SIP, to my mind, is a nirvana. If you do, and let's say if somebody continues this SIP for, this is 32 years, let's say, somebody started this SIP when a child was born in his family, that age was 0. And they said, after the child turns 25, the child will save 5,000 rupees from his salary and do this investment for 60 years till he retires. So if this child invests till his retirement and he gets only a 12% return, I'm not saying more, only a 12% return, this 5,000 rupee SIP, you know how much it will become? It will become 65 crore rupees at a 12% return. But you don't know whether the return will be 12%, 13%, 14%, 20%. At a 17% return, this SIP will become, at a 17% return, this SIP will become this will become 10 times, that's 890 crores. And God forbid if the return is 20%, which of course there is no guarantee and nobody can say, but I'm just telling you for mathematics sake, at 20% return, this SIP will become 4490 crore rupees. And that is what wealth is, investing for a longer period, automating your investments. So you're buying a ETF, which is probably the lowest cost fund in the market, and you're doing a SIP. And good investing should be risk focused. When you're investing in ETF, you're buying 40, 50 stocks. That means your risk is contained. And if your risk is under control, you will automatically stay invested for a very long-term time period because you're not afraid to lose money. Your risk is controlled. And T is time, not timing. Investors don't need to time the market. Investor needs time in the market. I have a goal, let's say 5 years down the line, I want to buy a house. Now I know that I need something for 5 years. I know that after 15 years, I will retire. So that means my retirement goal is 15 years. That's a long-term goal. So if I can divide my goals into short-term, medium-term, and long-term, and choose an investment product, and let's say in this case, an ETF. There are many ETFs available. There are gold ETFs, there are silver ETFs, there are commodities, there are international ETFs available. You have to just choose a product. Large cap, then mid cap ETFs, everything is available. When you're buying a basket of stocks, when you're buying 40, 50 stocks, your risk is contained. And when your risk is contained, it will be very easy for you to give the time in the market. The day you plant the seed is not the day you eat the fruit. So people who bring sorrow to their life are those people who want to trade, who want to make profit every day. I'm not saying trading is bad. I'm not saying that. If you do not have knowledge of trading and still you are investing, then you are inviting danger. So there is a Nifty 50 index, there is Nifty Bharat Bond Index, there is gold ETFs are available, silver ETFs are available, there are global ETFs available, Nasdaq 100, Hang Seng Index, there are indices in the German market. And one of the very interesting data I was looking at a couple of days back, the largest traded stock in US market is not Apple. Apple will probably be doing a daily volume of $2 to $3 billion. Maybe $7-8 billion, not $2 to $3 billion. But the largest traded stock is S&P 500 ETF, $20 billion every day. So what does it show? That the smarter investors have already started moving to ETFs. Some of these features, which I will very quickly cover. ETF is not worried about beating the market. It says whatever the market gives, I'll give you the same return. Only thing is you can choose the timing of exiting. So you can exit during the day, you can exit early in the morning, you can exit at the end of the day. But it's reflecting the returns of the market. It's not an active fund. So somebody very interestingly said ETF is like, there are 3 metals: gold, silver, and bronze. So bronze is the lowest return product. Gold is the highest return product. So probably you can say gold will be those actively managed funds where fund managers are taking active calls. ETF is the silver medal. And silver medal we know is very good. If you can get silver medal kind of returns all your life, it's amazing. And because the cost of ETF is low, over a longer period, the expenses that you save, let's say today an actively managed fund is charging you 1.5%. ETF is only charging you 0.5% or 0.10%. That is a saving of almost 1.4% every year. Over a 60-year period, over a 10, 20-year period, these returns itself can become very, very big. And we have seen that a lot of funds have not been able to outperform the indices. ETFs have very low fund expense ratio. So what is the secret of buying any good product? The mileage should be good. When we buy a car, the mileage should be good. That per kilometer expense should be low. In ETF, the expense is only 5 paisa. Other equity funds are charging you 1.75, 1.8, even 2%. It has complete transparency. You need not see anything. Your index is bought. Complete transparency. You can see the value of your fund go up and down on real-time basis. Nothing can be more transparent than that. You will exactly know what my portfolio is. In a normal mutual fund, you don't know. Your month-end portfolio is shown, but you don't know what was your portfolio on 20th, what was your portfolio on 15th. Here, everything is in front of your eyes. Low entry barrier. Any investor The butcher, the baker, and the candlestick maker, everyone can be here. You need very small amounts. A Nifty 50 ETF is, per unit, 200 rupees, 100 rupees. That is the cost. You don't have to invest 5,000 rupees also. So even the smallest investors can participate in the growth of Indian economy by participating in ETFs. And we know that government disinvested through ETFs. The entire process of buying and selling can be done with one click. You don't have to fill mutual fund forms. You don't have to wait for your NAVs. You can straight away do it. In less than 5 or 6 microseconds, your trade will be settled. So just as, we buy groceries and do online shopping, we can do the online shopping for ETFs. Most important thing is, how do you choose a good ETF? Is expense the only thing? Is portfolio the only thing? Or are there other factors? The first is the size of the fund. The larger the fund, better it is. The bigger the fund, better it is, because there'll be more liquidity. The fund house will have more money, more cash in their hand to settle your trades. Second, trading volume. Higher the trading volume, better it will be, better liquidity. The market makers will not be needed. The fund only can redeem your units. Third thing, which is very important, is tracking error, because ETF has certain expenses. Let's say index has given 15% return, ETF will give slightly lower return. The difference is the tracking error. So this tracking error should be very low, because let's say an investor has redeemed now, the fund will have to sell the stocks. There is a time lost between placing these orders. This will give rise to a tracking error. So the funds with lowest tracking error will be better. The bid-ask spread should be low. That means, let's say, you want to buy at, let's say, X price, but the buyer is asking you X plus something, and you want to sell at Y price, but the seller wants Y minus something. The lower this gap, the better it will be. Just as it happens in stock. You want to sell a stock at 200 rupees, somebody wants to buy at 195. So lower the spread, better it will be. So larger funds, higher volumes, low tracking error, low bid-ask spread, and of course, very natural, lowest expense ratio. And these are some of the indices where ETFs are there: Nifty IT, Nifty CPSE, Nifty Bank, Nifty Bharat Bond, Nifty 50, Nifty Next 50, Nifty One Day Rate, Nifty Private Bank, Nifty other indices. So passive funds, obviously they have certain advantages. They're not taking any undue risk. They are just replicating the market, which in the long run is a very, very smart strategy to play. If you can get a market-linked return for a longer period, it is amazing. And market-linked returns are easier to get when you are buying portfolios. When you're focused on individual stocks, there could be difficulties. There could be challenges related to stock picking. So ETF is for everyone: an experienced investor, a long-term investor, a novice, a small investor, a large investor. All of them at the end of it can speak the language of money, can speak the language of achieving their financial goals, can speak the language of smartness, the way I've told you, SMART. They are keeping things simple, they are market oriented, they are mindful, they are risk focused, they have automated their investments, and they are spending time in the market. Investing is a journey which should be enjoyed. Yes, we know that there are no guarantees. At the end of the day, there are no guarantees. There are so many things in life where there are no guarantees. And let me just end my session with a couple of lines which somebody told me, and this is in Hindi. So people who don't understand Hindi, I'll try to translate it for them. कि उम्र जलवों में बसर हो ये जरूरी तो नहीं, हर शबे गम की सहर हो ये जरूरी तो नहीं. There are no guarantees in life. So if you are having sorrows in evening, there is no guarantee that you will have a brighter morning. God doesn't guarantee anything, but still we live our life. कि उम्र जलवों में बसर हो ये जरूरी तो नहीं, हर शबे गम की सहर हो ये जरूरी तो नहीं. नींद तो दर्द के बिस्तर पे भी आ सकती है, उसके आगोश में सर हो ये जरूरी तो नहीं. एवरीबडी इज नॉट लकी टू फाइंड द लव ऑफ हिज लाइफ. पीपल स्लीप एट फुटपाथ ऑल्सो. और शेख करता है जो मस्जिद में खुदा को सजदे, उसके सजदों में असर हो ये जरूरी तो नहीं. वेरी इंपॉर्टेंट. लॉट ऑफ पीपल गो टू मंदिर, मस्जिद, गुरुद्वारा, चर्चेस. Some people go there to do bhakti, but there are a lot of people who go to temples to pick pockets, to steal shoes, and some people just go to temples or these places as only tourist attraction. Oh, there's a famous temple there, let me go and visit. There's no bhakti in their heart. Investing is like that. A lot of people are investing for fun. A lot of people are investing for experience. They're saying, okay, I'm just here to learn. But how many of them are focused on their financial goals? That is the question. और आग को खेल पतंगों ने समझ रखा है, सबको अंजाम का डर हो ये जरूरी तो नहीं. It is very important to take risks in life, but not blind risks. You have to take calculated risk. And how do you take calculated risk? You say that I will create a system which will limit my risk. I will take risk, but I will take limited risk. I'm not going to take a blind or naked call on the market. If you're a new investor, if you're just learning your ropes, if you're not confident of, participating in equity, or if you are an experienced investor also, believe me, ETFs are the right thing for you to do. The core part of your portfolio, which is at least 60 to 70%, should be in low cost ETFs. And I'm not saying index funds, because index funds, you will get the day end NAV. ETF gives you that flexibility. You want to sell whenever you want to sell, you can sell. The core part of your portfolio should be composed of ETF, and the world is already moving in that direction. Today in India, everyday volume of ETFs is about 155 crores. And the satellite part of your portfolio can be the other, small cap stocks, large cap stocks, small cap funds, sectoral funds. That is the way to invest. So let me repeat what we have discussed here, and then I'll open the question and the session for question and answers. We have to pick up a smart way of investing. We have to focus on our goals, divide these goals in short, medium, and long term, and invest accordingly. And today, if you look at Indian market, there are ETFs available which can help you in short term. You can buy a bond ETF, which will help you in short term. You can buy a small cap ETF, which will help you in the long term. You can buy a mid cap, large cap ETF. And the third thing is control your expenses and the risk. Go into those products which are not costing you the moon. Because even if you generate market-linked returns, you will be able to create wealth. Remember, you don't have to be the smartest. You don't have to be the first. And you don't have to be at the top. Even if you're average, you will do very well. And these are not my words. This is what Warren Buffett says. So thank you very much, ladies and gentlemen, for being here in this session. I will request our IT team to open the session for question and answers. So we have about 10 to 12 minutes. We can take question and answers. Amit, can you help us? I think we already have some questions. So yes. Amit, yeah. So we can start with the first question. So what we've done is we received about 300 questions, and some of the questions we are not allowed to answer here. So those questions we have removed, and then we looked at duplicate questions. So most of the questions which you have asked will be covered by these 7-8 questions which we will answer. Yes, Amit. And please announce the name also of the person who has asked that question.
Sure, sir.
Yeah.
So we have first question from Ms. Asha Pillai.
Yeah.
Her question is how to recognize the good ETF.
So Asha ji, as I mentioned a couple of slides before this, these are the 5 things: low expense ratio, higher volume, low bid-ask spread, low tracking ratio, and the size of the fund. These 5 things will tell you which is a better ETF.
And sir, her second part of the question is how much to be invested to get 1 crore in 4 years?
So 1 crore in 4 years, I think this question, Asha ji, can be better answered by your advisor. What he will do is, I cannot, of course, tell you because for that I'll have to assume returns. What your advisor will do is, he will ask you to, let's say 4 years. So typically he will ask you to invest in large cap and he will assume a return. Let's say he assumes a return of 12%. So he will assume a return of 12%. Then if you have lump sum, he will tell you that this much lump sum needs to be invested. And if you do not have lump sum, he will tell you the size of the SIP. But if I were to do a back of the envelope calculation, I think you will need to invest, I think about 1,75,000 rupees types every month. I'm just doing a very rough calculation. If I go to a calculator, I can do better calculations. But because I can't answer this question very directly, so please excuse me. Yes, Amit, please move to the next question.
The second question is from Miss Nikita. What is a smart investment?
So Nikita, smart investment, as I mentioned, it should be simple. Second, it should give you market linked returns at a lower risk. So when you're buying an ETF, what is happening? You have bought the entire market. You bought those 40, 50 stocks. So there are two types of risk in the market. One risk is that nobody can remove that risk. A Ukraine risk, you and me cannot remove. A demonetization risk, you cannot remove. That is called systematic risk, which is coming from system. The second risk is the diversification risk, the non-systematic risk. ETF will completely remove the non-systematic risk, which is not related to the system. So it should remove the risk. When risk is removed or risk is reduced to a greater level, what will happen is the fluctuations will be less. Let's say if you bought one stock and if you bought an ETF, the ETF will be far less volatile. It will make you invest for a longer period and it needs to be tax efficient. ETFs are very tax efficient. Your taxation is same as mutual funds. So it should be simple, easy to understand, easy to execute, tax efficient, which ETFs are. It should control your risk on the downside, which ETFs do very, very well. And most important, over a longer period, it gives you market related return, helps you beat inflation. Yes, Amit.
Yes. The third question is from Ashish Singh.
Yeah.
How ETF is a way in wealth build up in long run?
So Ashish, the answer is very simple. Markets, if you look at the long-term history of the markets in India, your long-term returns have been 14 to 15%. When you buying an ETF, you are actually getting that kind of return. Now, can you get better return than that? You can get better return. But let's say you are an investor who doesn't know how to pick up stocks. So what will you do? So ETF, to my mind, is an ideal instrument which can help you get market link returns. And if you can get market link returns over a longer period, let's say 10, 15, 20 years, your wealth will be automatically created. I gave you a very simple example of SIP. A 5,000 rupee SIP for, let's say, a long period can give you thousands of crores of rupees. Do that SIP in ETF and see the magic. Yes, Amit.
The next question is from Miss Ritu Himlani.
Yeah.
She says, sir, I'm scared to trade in options after losing the big amount.
Yeah. So Ritu, there is no need to trade in options. I'm not saying options are bad. They might be, a lot of people who are making good money. But if you are not aware of the options, I told you, avidya, if you do not have knowledge of a field and still you are operating in that field, you will bring sorrows back. So no need to dishearten yourself. No need to get discouraged. If you've lost some money in options and derivatives, it's okay. All of us have lost money some point of our life. Start with a simple instrument. Start with an ETF. That's the best thing to do. And invest in small amounts, invest regularly. In 3-4 years' time, you will be ready to face the world again. It's okay. So use ETFs. They will help you a lot. Yes, Amit.
The next question is from Mr. Danish.
From?
What advice would you give to novice investors who have just begun investing?
So I think if you look at the entire presentation, the maximum benefit of this presentation and maximum benefit of ETFs can be taken by those investors who are new to the market. You will get market linked returns at a lower risk, and you will not lose any opportunity in the market. And once you spend few years in ETF, then you can move to other products. So Amit, a novice can get benefit of ETFs because they will help him get a market linked return, and they reduce lot of risk and they are affordable. So what more can be said? Yes.
We have next question from Mr. Akshat Jain.
Yeah.
He says, is NSE certified or not?
Okay, are these ETFs certified by NSE or not? No, these are not certified by NSE. NSE is only helping you invest and disinvest in them. All the ETFs are mutual funds. They are regulated by SEBI. Okay, so NSE is providing you the platform.
The next question is from Abhishek Sharma.
Yeah.
How to know about fundamental of companies?
Okay. So see, what are the fundamentals of companies? Abhishek, when you look at a company, you should understand the business of the company. And you should also be able to find out by how much the company will grow in the future. So that's one part of investing. Second part is, how is the current business doing? So for that, you need to study the balance sheet, cash flow statement, and the profit and loss account of the company, which will tell you how efficiently the company is using the capital, what is the return it is giving on equity, what is the return it is achieving on the debt capital, by how much is the business growing, what is the competition, what are their margins. So these are some of the fundamentals. How do you learn about them? You read company balance sheets, you go to websites, you talk to brokers, you talk to people who are tracking those companies, then you can know about it. And if you don't want to go through all this rigmarole, buy a ETF or buy a mutual fund. Yes, Abhay. Amit, are there any more questions?
Yes. The next question is from Abhishek Sharma.
Yeah.
How to know about fundamental of companies?
This I have already answered.
Sorry. Yeah. Next is from Abhay. Is ETF investment better than equity stock investment?
Yeah, it is much better because equity stock investment, you are taking higher risk. Your risk is concentrated in one single stock. When you're buying ETF, your risk is divided in 50 stocks. Second, in equity stocks, you have to pay STT while buying and selling. In ETF, you're paying STT only on selling. But forget about STT. Equity investing is very risky for a new investor. So unless and until you know about equity investing, please do not do that. ETFs will be much, much safer. So ETFs are cheaper, ETFs are low risk.
We have last question from Mr. Pritesh.
Yeah.
Difference in Nifty ETF and index fund, and which one is better?
So see, if you look at the portfolio, let's say there is a Nifty 50 index fund and Nifty 50 ETF. The portfolio will be same. The expense ratio might be slightly different. Index fund might be slightly more expensive. The only difference here, Pritesh, is that index fund, you will exit at the day end prices. So if the index is up that day, index fund NAV will be up that day, and you can exit or enter at the day end prices. ETF can be traded like a stock. So ETF is nothing but an index fund that can be traded. A normal index fund cannot be traded. You have to come out at day end NAV, but ETF can be traded at any point of time during the day. So you can invest, disinvest, anything. So all the flexibilities which are available with mutual funds and stocks are available in ETF. So ETFs are much better than the index one. That's my sense. Yeah.
That's also.
Okay, great. So we've come to the end of question and answers. We had allotted a time of 1 hour for this program. So thank you very much. I hope we have been able to add some value, and we would love to receive your feedback about this program. Thank you very much. I would like to sign off. Mihir, can we sign off, or is there any thing that you...
Yes, sir. Yes, sir. Again, on behalf of NSC, I would like to thank I would like to thank you, sir, for presenting today's session, and I also would like to thank our audience for attending our session. So, thank you very much for attending our session, and have a great evening.
Yeah. Thank you very much. Good night, everyone. And thanks a lot for helping us organize this. Thank you.
Yeah. Thank you. Yeah.